This is ShadowQuant Forex Edition, brought to you by AriesLabs.ai. Before we begin, please note, what you are about to hear is an AI agent panel. All analysis, voices, and production are generated by artificial intelligence. Nothing you hear constitutes financial advice. Always do your own research. Today is Monday, July 6, 2026, and this is the New York session. Now, let's get into it. Markets are gripping the railing. The Fear and Greed Index has plunged to 14 extreme fear territory as the US dollar asserts total dominance across the board. With gold testing key support and the yen trapped under immense selling pressure, the question isn't whether risk is off the table, but how fast capital is fleeing it. Let's get to work. Looking ahead to the calendar, the immediate horizon brings the Reserve Bank of Australia rate decision on Tuesday, July 7 at 4:30 UTC. This is the primary catalyst for the Australian dollar, specifically Aussie dollar, which is currently sitting under pressure. Additionally, we have the dollar GDP now estimate coming on Wednesday, July 8, which will provide a fresh data point on economic velocity as we navigate through the current inflation readings.
To put that in context, Pulse highlighted the stagflation-light environment created by that flat yield curve. The Reserve Bank of Australia decision won't just be about rates. It'll be a stress test for whether the Aussie can withstand the current flight-to-quality wave given the global backdrop.
Here is the snapshot as of 9:30 Eastern Time. The Fear and Greed Index sits at 14 out of 100. The VIX is at 15.81. Leading the charge is the US dollar, with dollar-yen at 161.84 plus 0.24%, and dollar Swiss at 0.80445 plus 0.8%. On the flip side, risk assets are bleeding. Aussie dollar is down 0.15% to 0.69259, and euro dollar is down 0.4% at 1.1432. Gold is at 4,166.6, down 0.41%, while silver trails at 61.84. The macro picture is stark. We are operating in a structural higher-for-longer regime. Core PCE is holding at 3.41%, and headline CPI is at 4.17%, both significantly above the Fed's 2% target. This validates the current hawkish bias. Meanwhile, the 10-year, 2-year yield curve is flat at positive 0.35 basis points. That flatness, combined with sticky inflation, creates an environment that fundamentally favors the greenback over growth-sensitive currencies. The labor market, with unemployment at 4.2%, isn't screaming for relief, so the Fed's hands remain tied.
And look at the leverage fueling this fire. DXY leveraged funds have surged by positive 4,438 contracts week over week. Asset managers added another 22,196 contracts. This isn't just noise, it's institutional conviction. Conversely, look at the Japanese yen. Speculative shorts have hit negative 97,092 net contracts, a massive negative 98,892 change week over week. That is an overcrowded, fragile book. And on the flip side of risk, RC leveraged funds are heavily long at positive 39,111 net contracts, right when the currency is trading near 5-day lows.
Here is the problem everyone is missing. The VIX is at 15.81. It is suppressed, but the Fear and Greed Index is at 14. You have a massive decoupling between implied volatility and actual sentiment. The market is pricing in zero movement while sentiment is in freefall. That VIX level of 15.81 is dangerously low compared to the 19.45 high we saw recently. Complacency is the enemy here. If that flat yield curve of positive 0.35 basis points flips negative, or if the Reserve Bank of Australia surprises, we aren't looking at a slow grind. We are looking at a volatility explosion because nobody is hedged.
Let's look at the headlines shaping this morning. First, dollar Swiss bounces higher after testing support targets at tail end of last week. What now? Second, the US dollar starts the North American trading week on firmer footing. And third, Euro-dollar continues to erase the non-farm payrolls gains as focus remains on the USDJPY data. What's next? Those headlines confirm the divergence. The Eurozone is seeing producer prices pick up in May, which contrasts with the U.S. narrative. However, because U.S. inflation is stickier at 4.17% versus a cooling Eurozone energy mix, the relative yield advantage still pushes euro-dollar down to 1.1432. The ECB is playing catch-up on inflation, while the Fed is fighting an ongoing battle. That structural gap keeps the euro under pressure.
The flow data backs that up. Euro-leveraged funds remain bearish at negative 15,410 net contracts, with a further decrease of 13,103 week-over-week. Money is exiting euro exposure systematically. It's not just about the headlines, it's about the persistent outflows from the single currency basket as capital seeks the safety of the dollar and, to a lesser extent, gold.
Let's dive into the technical structure of dollar-yen. It's trading at 161.84, up 0.24%. We've seen a clear break above the 161.46 open, pushing price toward the upper bounds of its 5-day range.
Technically, this is a textbook breakout. Price cleared the 161.46 intraday pivot with conviction. We are now tracking the 5-day range of 160.4835 to 162.8395. The momentum is clearly biased toward the upside. There are no rejection wicks yet. The candles are closing strong. Until we see a daily close below that 161.46 breakdown level, the trend remains uninterrupted. The structure favors continuation toward the 5-day high of 162.84.
But grid, you're treating this like normal flow. It's not. Look at the CFTC data. Negative 97,092 net short contracts in yen. A week-over-week change of negative 98,892. That is a liquidity trap. When price hits 162, you won't see organic buyers stepping in to push it higher. You'll see mechanical covering from those shorts. The resistance at 162 isn't just technical, it's a detonation zone for forced buying. Standard technical analysis assumes orderly markets. This book is overloaded.
Exactly. SPECTER here agreeing with CIPHER on the risk. If dollar-yen touches 162.84, the VIX won't stay at 15.81. The sheer volume of those shorts means any hesitation triggers a cascade. You're asking for a smooth ride on a bed of nails. The short squeeze risk is asymmetric. If it pops, it doesn't go up a few pips. It goes up 50 or 100 pips instantly as algorithms chase the liquidation. That is a volatility event waiting to happen.
I respect the volume argument, but I'm sticking to the chart. The price action hasn't shown capitulation. There are no long upper wicks, no failed breakouts. As long as price stays above 161.46, the bulls are in control. The short covering might accelerate the move, but it doesn't negate the direction. The trend is up until proven otherwise by price structure, not by COT reports.
Shifting gears to Aussie dollar. It's at 0.69259, down 0.15%. We are seeing weakness across the board, but Australia is facing specific headwinds ahead of the Reserve Bank of Australia decision.
On the chart, Aussie dollar is compressing tightly around the 0.692 threshold. We are trading at 0.69259, hovering just above critical support. If that 0.692 level breaks, the next stop is the 5-day low at 0.68829. The structure is fragile. We are seeing lower highs forming on the hourly charts, indicating that sellers are stepping in aggressively at every rebound. The 0.692 level is the line in the sand.
And that line is incredibly dangerous for leveraged longs. Positive 39,111 net contracts long in Aussie. That is a crowded trade. When you have nearly 40,000 contracts piled into longs on a currency that is losing momentum, a break of 0.692 doesn't just mean a small drop. It means a margin call spiral. The positioning is completely contrary to the price action. Everyone is betting on a recovery, while the market is ticking lower.
That positioning sets up a disaster if the Reserve Bank of Australia turns hawkish. We know the US is stuck at 3.63% rates with sticky inflation. If the Reserve Bank of Australia holds steady or hints at hikes to combat local pressures, the interest rate differential widens against the Aussie. Combined with that crowded long book, you have a perfect storm. The fundamental divergence supports the technical breakdown.
Let's talk about the Strait of Hormuz. One of the headlines noted that a week later and not much has changed, but geopolitical risk premiums don't disappear, they accumulate. When you have extreme fear, 14/100, and a flat yield curve, any spike in Middle East tension immediately funnels into safe havens. Aussie is a risk proxy. It gets sold hardest when fear spikes. The lack of volume in Aussie isn't stability. It's absorption before the sell-off accelerates. The liquidity is thin, which means the drop will be sharp when it comes.
Finally, let's look at gold. It's at 4,166.6, down 0.41%. Despite the strong dollar, gold is holding firm, though it's been rejected at the 4,200 psychological level.
Technically, gold rejected the 5-day high of 4,203.23 and has pulled back to 4,166.6. We are testing the 4,160 support zone. The structure shows a double top formation at 4,200. Failure to hold 4,160 could expose the 4,100 level. However, note the divergence. While euro-dollar and Aussie dollar are sliding, gold is merely dipping. It's absorbing the safe haven flows that aren't going into the dollar. The 4,160 level is active demand.
Look at the flow contrast. DXY leveraged funds are up 4,438 contracts, but gold is still attracting inflows. In times of extreme fear, 14/100, gold acts as a secondary reserve currency. The fact that it isn't crashing alongside equities or Aussie shows that smart money is diversifying away from pure dollar exposure into hard assets. The 4,160 level is being defended by long-dated capital.
But watch the VIX again. If the VIX stays at 15.81 while gold tries to rally, that's a false signal. Real safe haven buying usually coincides with a spike in volatility. If gold rises on a low VIX background, it's often a liquidity trap traders trying to catch a falling knife before the volatility expands. Monitor the 4,160 level closely. A break there during low volatility could trigger a flush to 4,100.
Synthesizing this morning's data, Apex, what is the dominant theme?
The dominant theme is dollar dominance, but with structural fragility. Pulse confirmed the higher for longer inflation regime supporting the dollar. CIPHER validated this with the 4,438 contract surge in DXY leveraged funds. However, Grid's technicals on dollar yen at 161.84 and CIPHER's warning about the minus 97k net yen shorts create a paradox. We have a strong trend built on a crowded, fragile book. Similarly, Aussie dollar at 0.69259 is technically weak per grid, but fundamentally supported by the flat yield curve and risk-off sentiment identified by Pulse. The risk flag here is SPECTER's VIX/fear divergence. The market is quiet, VIX 15.81, while sentiment is panicked, 14/100. The trade is long dollar/short risk, but the execution must account for potential volatility spikes in yen and Aussie due to the overcrowded positioning described by CIPHER.
Key takeaways for this session. The US dollar is structurally favored by sticky US inflation and flat yields. Dollar yen is in a technical breakout mode, but carries extreme short squeeze risk due to COT positioning. Aussie dollar is nearing critical support at 0.692 with a crowded long book that poses significant downside risk. Finally, the divergence between the suppressed VIX at 15.81 and the extreme fear and greed score of 14 indicates that volatility expansion is overdue. This is AI-generated content for informational purposes only, not financial advice. That wraps up this edition of ShadowQuant Forex Edition. Stay tuned for the after-hours session where we will see how these calls play out. Until then, trade safe.